This has been Reppond. Today is February 8, 2022. We're going to do a little different format than we've done in the past. We're doing a once every 2 weeks stock market and economic indicators, and covering the economy and the Fed and inflation, etc. We'll be doing those in the future every other week. So this week, alternating weeks, I will just focus on the stock market, and then every other week will include the stock market and economic news. We'll start out with the S&P 500. Looking back over the past year, this is a weekly chart. Every movement in the chart is a representation of 1 week. So there should be 52 changes in this line over the past year, including the last week. So you can see on the right end of the chart with the red arrow, you can see the movement of the S&P 500 represented by the exchange traded fund SPY, SPY. I put on there a 20 period moving average, so you can see where the market was as of Friday, below the line, below the 20 period moving average. This is it's an indicator, it's a bearish indicator showing that the market, the short-term direction of the market is in a downward direction. The long term is still up, but the short term is down. These are indexes, 6 of them, 4 US and 2 foreign. I'll cover these. You can see that the majority of the periods are red, indicated on the right side of the chart. This is the 20, 50, 100, and 200 day moving average for that index. The S&P, represented by SPY, and the Dow, represented by DIA, are the only two that have green dots showing that they are above their moving average, and that is the 200-day moving average. All the other averages, they are below that, indicating a short-term bearish condition. IWM is the weakest U.S. index. That's the Russell 2000, the small cap index, the 2,000 smallest companies on the exchange, and the QQQ, also weak, but IWM, the small cap, is the weakest. Comparing that to EFA, EFA is the foreign developed markets like Japan and Europe, and EEM, the emerging markets, also quite weak, and that for all the periods, 20, 50, 100, and 200 period day moving averages, they are all in negative territory. So we saw through the month of January that the market went down significantly, the S&P going down about 10%. I think it finished about 8% down, but at its worst point it was down around 11. Definitely a very bad January, and it's recovered a little bit, as you saw in the previous chart, covered a little bit in the last week or two, but it is still weak, and so it could continue to go on down from here. We don't know, but all of the managers that I follow, active managers, and all of the indexes and financial people who follow technical indicators, all of them are showing that we are still in a cautionary and probably a down market period. We have not hit the bottom, it appears, and are not headed up from here. Now, we don't know the future, but I'm going to say there is still weakness in the market. We compare in this chart the S&P 500 SPY to the growth stock index, and that is VUG. It's a Vanguard fund which covers basically growth stocks. And you can see that the S&P 500 was significantly higher during this recent period. It shot up relative to growth stocks. What that tells you is that using the S&P as a benchmark, that growth stocks were much weaker, making the S&P 500 look stronger by comparison. So it's good to do this kind of comparison, and you can see where it is relative to its 20-period moving average. Again, this is a weekly chart spread over a 12-month period of time. When we compare, earlier I said IWM, the Russell 2000 exchange traded fund, was very weak, and it's below its 20, 50, 100, and 200 period moving averages. And you can see relative to SPY, the S&P 500, you can see that the S&P 500 has consistently been stronger for most of the last year compared to the small cap index. This is another look at the market. Look at low volatility stocks compared to high volatility or high beta stocks. And that's represented by the fund, the exchange traded fund, SPLV versus SPLG. And so an upward movement will show that low volatility was in favor. A downward movement would show that high volatility or high beta was in favor. It is still above its 200 period moving average, which shows that low volatility in general, from a macro view, is still more in favor than growth stocks or high volatility stocks and high beta stocks. Now we're going to jump over to bonds. This is the TLT, is the ETF. TLT is the long-term government bond ETF, and this is just showing it. It's not compared to anything, but you can see for the last couple of months, you can see the weakness in long-term government bonds, definitely headed down. And relative to stocks, it's definitely weak. So what's interesting about this is that the TLT, or government bonds, whether they be intermediate term or long-term government bonds, or for that matter, I guess you could say short-term government bonds, are used as an antidote, as a countermeasure to stocks, to equities, by traditional financial advisors. And the vast majority, I'm going to say well over 90%, use this as a way to soften risk against equities. That has worked for the past 40 years in general, since the early 1980s. However, as I've said before, now that interest rates have hit at a low point, at or near zero, and are starting to go up, there is only one, and the yields on government bonds track interest rates, are correlated to interest rates. So as they go up, the bond funds or bond ETFs have nowhere to go but down. So this chart is showing that as equities declined, so did bonds or bond funds. And so what used to be there as a traditional measure, now this is a short period of time, but I think it is a precursor to a long-term trend, which is that as interest rates go up, the bond funds are going to fall down and maybe even collapse. Goldman Sachs has indicated that they expect the Fed to raise interest rates this year 5 times. Bank of America said 7 times. The general consensus is at least 4 times. So as rates go up, bond funds are going to come down. This does not serve as the countermeasure to stocks if stocks collapse. It, at a minimum, is going to put a huge drag on an upward movement of stocks and will collapse along with the stocks with these moves up. So I'm saying all of that to say this: the countermeasure, the traditional countermeasure for equity risk, is disappearing. It is not what it was for the last 40 years. If you go back for the 30 years prior to 1980, from 1950 to 1980 approximately, you would see over that period of time, that was a period of rising interest rates, and again, for 30 years, bonds headed in a downward direction. I think we're entering a period like that, and there are many experts. You think of Alan Greenspan, Jim Rogers, Warren Buffett, Scott Minerd, David McIlvaney, others who are independent thinkers, and they are all saying stay away from bonds, or there are two bubbles that are forming, stocks and bonds, meaning that there is a risk of both of them coming down together. And this is beginning to show the correlation with stocks and bonds. When I compare the S&P 500 SPY to TLT, the long-term government bond ETF, you can see that the S&P 500, as weak as it's been, it's better than government bonds. I thought I'd put this in just to show you, it says something about gold. Now, this is not gold itself. This is paper gold, made up of derivatives in GLD, the ETF GLD, SPY versus GLD. So the more this goes up, the more it's going to favor the S&P 500 SPY, and the more it goes down, it's going to favor gold. What it shows is, it's an interesting chart because it shows the upward direction of the S&P 500 relative to gold, outperformance. But then as stocks dropped in January, gold did not, or did not as much. It held its value relative to the S&P 500, showing that the S&P 500, SPY in this case, dropped relative to the price of gold. So gold was a stabilizing factor in a portfolio to prevent, to be a countermeasure to equities. And then as equities have gone up at the very end, gold has not. It's held its value and showing that rise at the end, which is relative to gold. So the S&P 500, stock market in general, had some volatility, but gold did not relative to the S&P. So you can see that on the chart. Then we're going to go over to Asbury Research. Asbury Research puts together a number of ways to look at the market. One of them is they develop what they call the Asbury Six, which are 6 different technical indicators. 2 of those recently, this last week, turned positive. 4 of them are still negative. Their view is each time a different indicator turns positive or negative at different times. So there's not a consistent pattern. But their view is that in general, whichever 4 there are that remain negative, that it is still bearish conditions. Or if 4 go positive, though that is an indication of bullish conditions in general, a good indicator of the direction of the market. At this point, as of Friday, there are still 4 of those that are negative, indicating that the market is still in a bearish condition when measured from the 6 different perspectives of Asbury Research. They break the stock market down into its 11 sectors. You can see financials, energy, technology, utilities, etc. And they take the view of this past week, this past month, and this past quarter. Sometimes there is consistency weekly, monthly, quarterly. and as things move around, they change positions. If it does not have a red color to it or a green color to it, it means it's closer to neutral. But the only one that has consistency over that period of time is consumer discretionary. All the other sectors might be starting to look positive. That would be just those two green ones in the center. Or for the last month, two green ones. Or for the last quarter, two green ones. Not showing an upward trend, whether looked at from a weekly, monthly, or quarterly perspective. On the other hand, there aren't many red ones either, showing a negative decline. It is, to me, I interpret this, other than consumer discretionary, I would interpret this as most sectors in the stock market are mixed. It is an uncertain period, not a period right now that is necessarily by sector going down, and not one that's going up. The other way they look at it is cross-asset relative performance, comparing types of assets to each other. It's an interesting view. There were 5 comparisons that had consistency for a weekly, monthly, and quarterly view. And I highlighted those on the left. High beta versus low volatility. We looked at that already. Low volatility was more in favor in all 3 periods. Large companies versus small companies, large for sure. And I showed you that in the S&P 500 compared to the small cap index IWM. And the S&P 500, the broad market, compared to the growth stocks, the NASDAQ 100, in all 3 time periods, the S&P 500, which is a mixed large growth and value index compared to a growth-only index, the NASDAQ 100, in all cases, the S&P 500 was stronger. Again, I showed you that in a previous chart. The U.S. market versus developed markets in all periods, we saw that as well. S&P 500 was stronger than U.S. developed markets. And then over in the bond area, fixed income, government versus corporate bonds. Even though government bonds have suffered, corporate bonds have suffered more. So relative to each other, government was still stronger. And then the other periods, the other comparisons are mixed and not as definitive. The final view is the view of the U.S. versus other countries. Now this is interesting because this is the flow of funds, flow of money from country to country. If we go back October, November, we would see that this was almost all U.S. Then in the past month, maybe a month ago, you may remember I showed this, and the U.S. was hardly on here at all. So during the month of January, while the U.S. market was going down, these other markets, in most cases, were going up. So the flow of funds left the U.S. and they went to these other countries, a collection of about 20 countries. Now, during this past week, the flow of money, big money, institutional money, and traders, not so much the individual investor, but those who are moving money where money is treated best, has now come back into the U.S. So the last week, the view from the last week is primarily U.S. And you can still see some remnants of the last month and the last quarter. And the only exception to that is Brazil. Brazil for the last month, quarter, last week, all flow of money was still going in the direction of Brazil relative to the U.S. and relative to the other countries. So it's interesting to see how money goes back and forth, big money, large amounts flows into countries or out of countries. And because the U.S. market went down, and other markets might have gone down too, but not as much as the U.S. Do you remember last year, it was about March through the month of August, During that 6-month period of time, one of the very hot stocks was Facebook. Facebook was moving and went up 59% in that 6-month period. Boy, was it hot. And by the time it got to the end, I think it was starting to suck in investors. This is definitely a stock that we want to be invested in. Until last week. And last week, Facebook dropped 29%, almost overnight. And today, it is still down, and going down. I don't know how far down it's going to go, but it has weakened. Do you know why? They say, I'm just saying what I read, which is that the reason is that Facebook has now gotten some competition. There's competition from TikTok and some other technology platforms that are drawing users of Facebook away from Facebook. Now, you may, if you use Facebook, you may still be using it and you may not recognize any of this, but there are large numbers of people going away from Facebook. As such, that gets reported in their user list, as they do announcements, they announce how many users they have, growth and rate of growth and decline, et cetera. So the increase in stock value is showing week over week, month over month growth in users, and it's expected that's going to continue. When that stops or when that starts to decline, this happens. And this announcement that the users had dropped, people knew where they were going, and this happened to the stock. This is why I do not recommend and do not invest in individual companies, individual stocks, because you not only have market risk, the stock market itself, you have stock risk, individual stock risk. And Facebook, while they've had a lot of growth, you saw that in the previous chart, with that comes decline. And it has declined, and any company, any individual company, this can happen to. I thought I would show you the Facebook chart over the past year, so you can see that period of time where Facebook went up. Over that long period of time, going up, going up, going up, going to the moon maybe. People thought, you need to get on board, you need to own some Facebook. A lot of people did, a lot of funds owned Facebook. And then you see the green arrow on the right? The green arrow is the beginning of last week. The black arrow points to where it actually ended. You don't even hardly see at the end of that 1-year chart that incredible drop from the green arrow all the way down to the black arrow. But that is, I put it into a micro view in the previous slide so you could see how far down it fell. So in the past year, yes, Facebook went way up, but then it came way down, going even below where it was a year ago. The risk of owning individual stocks, no matter what the stock is. And then do you remember GameStop? For less than a month, in the month of May and June, less than 30 days, GameStop went up 108%. And you may know the story behind it. The institutional the hedge funds were shorting it, and in came the small investor, and they decided to create a lot of problems for the hedge funds, the little guy versus the big corporate money, and they basically started buying the stock, pushing it up in that short period of time over 100%. But remember from the previous chart, what goes up must come down. This is the chart of GameStop since November 22nd of last year. So today it's less than 3 months. It has dropped 59%, going from a price of about 300 down to a price of 102. That's a drop of about 2/3. And It may go down further. We don't know. It's a very volatile stock. But it doesn't suck people in at the bottom. It sucks them in at the top. This is our human emotion that wants to get on board things that are winners. But companies like AMC, GameStop, Tesla, Facebook, all very volatile stocks. They go way up and they come way down. And then, of course, we know Bitcoin does the same thing. But again, when it gets to its highs, it tends to want to draw people in. I want to double my money. I want to go up 50%. That human psyche gets sucked into those. And we don't follow that approach. We use a very more cautious approach. Our goal is to completely minimize downside risk. So if we're going to minimize downside risk, we're not going to participate in things like this. So we may miss some of that very exciting, euphoric upside, but our goal is to definitely not participate on this kind of downside. We're trying to minimize the downside as much as possible. It may be a little more boring, but my goal is I want to sleep at night and I want our clients to sleep at night. But I thought I'd show you this because it's the flip side of the same coin. So we've covered the stock market from a variety of perspectives today, February 8th. And next week, we're going back to the full presentation next Tuesday, which will cover the economy, economic indicators, including inflation, the Fed, etc., as well as the stock market. So it'll be everything next week, and alternating weeks will be like today, where we will just be covering the market in probably a shorter version. If you have questions or comments, leave them below. And next week, I will be live, so if you leave comments, I'll be able to respond to them quickly. And thank you for watching.